All customers who had deposits in these banks can rest assured, I want to rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund. The management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works.
Almost everyone has heard by now that one of the biggest banks focused on serving startups and innovative tech companies collapsed in a matter of days. But a lot of things played into its eventual destruction. Here is a look at what ultimately led the US government to step in over the weekend. The biggest banking collapse since the 2008 financial crisis was spearheaded by a bank run on SVB Financial Group last week. But the gears had been turning for quite some time. Much of the problem stemmed from a combination of a short-lived surge in cash positions and a swift attack on inflation by the Federal Reserve. SVB Financial, the parent company of Silicon Valley Bank, counts many startups and smaller tech companies as clients. Deposits from these clients soared during the pandemic as many of them grew their cash positions exponentially amid record low rates. As deposits climbed, SVB decided to buy US Treasuries and government-backed mortgage securities with the influx of cash. As the US emerged from the pandemic with a flourishing economy, inflation started to dig its teeth into hard-working Americans' pockets. With inflation rapidly rising across the board, the Fed raised its fists and began to jab at rising prices with a series of aggressive rate hikes. The effects of higher rates lagged behind in inflation readings, but several companies started to feel the pain as investors backed out of high-growth names and cash positions began to dwindle. Given the rising rates environment, inflows turned to outflows, and SVB was forced to sell some of its longer-term treasuries at a loss to cover increased withdrawal requests. SVB sold out of its bond portfolio worth approximately $21 billion and recognized a loss of $1.8 billion, according to a release from last week. The portfolio was yielding just 1.79%, while the 10-year was yielding closer to 4% by Reuters. SVB also went to the public markets to raise additional capital, announcing plans to offer $1.25 billion of its common stock and $500 million of depository shares. As a result of the announcement, the stock tanked, which put more pressure on the bank. The panic in the markets sparked a bank run as several customers rushed to withdraw capital, and ultimately the bank's cash position ran dry. SVB then looked to find a buyer in order to source alternative funding, but the Federal Deposit Insurance Corporation, or FDIC, shut it down and placed the bank under receivership, according to Reuters. Over the weekend, the Fed stepped in to inject liquidity into the situation in an effort to make depositors whole. However, the bank itself can be chalked up as a zero. Depositors will be covered by the FDIC's Deposit Insurance Fund. Furthermore, the Fed also announced plans to create a new bank term funding program centered around protecting institutions impacted by the crash of SVB financial stock. It's not a bailout, so shareholders will not recoup losses and taxpayers will not suffer. The move simply aims to build back confidence in the banking system. Fed Chair Jerome Powell, Treasury Secretary Janet Yellen, and FDIC Chair Martin Greenberg said in a joint statement, "The US banking system remains resilient and on a solid foundation. in large part due to reforms that were made after the financial crisis that ensured better safeguards for the banking industry. Those reforms, combined with today's actions, demonstrate our commitment to take the necessary steps to ensure that depositors' savings remain safe.